Ever wondered how big traders move millions of shares without wrecking the market? It's like trying to steer a ship through a storm too fast, and you capsize, too slow, and you drift off course. Today, we're diving into a breakthrough that's changing how we tackle this high-stakes puzzle. A new trading model that learns, adapts, and outsmarts the chaos of real markets. Let's start with the basics. When you buy or sell a huge chunk of stock, it's not just about the price, it's about how you do it. If you rush in, the market reacts, and you end up paying more than you bargained for. This is the optimal execution problem, balancing speed, cost, and risk. For decades, traders used models like the Almgren-Chriss framework, which assumed things like fixed volatility, prices don't swing wildly, and linear market impact. Bigger trades just raise prices proportionally. But here's the catch. Real markets are anything but predictable. Volatility flips, liquidity dries up, and the cost of trading doesn't follow a straight line. Traditional models, they struggle to keep up. So how do we fix this? Enter FlowOE, a game-changing approach that uses imitation learning and flow matching to adapt to the chaos. Think of it as a financial AI that doesn't just follow rules, but learns from the best strategies out there. Instead of starting from scratch, FlowOE watches expert traders, like the Almgren-Chriss model or other AI agents, and picks up their secrets. If the market is volatile, it mimics a strategy that prioritizes risk control. If liquidity is tight, it switches to a more cautious plan. It's like having a smart, adaptive assistant that adjusts its game plan as the market evolves. What makes FlowOE special? It uses flow matching, a cutting-edge AI technique that's great at handling complex, changing data. Imagine teaching a robot to walk by showing it videos of humans moving. Flow matching does something similar, but for financial strategies. It doesn't just copy patterns, it learns the underlying dynamics of market behavior. This allows it to handle nonlinear effects, like sudden price drops from large trades or the lingering impact of liquidity shocks. But let's get technical. The researchers behind FlowOE built a simulation environment that mirrors real-world market conditions. This environment uses the Heston model, a sophisticated framework that accounts for stochastic volatility, random, evolving price swings, rather than assuming constant volatility. It's like upgrading from a flat map to a 3D terrain model for navigating a financial landscape. At the core of this setup is a Markov Decision Process, MDP, a mathematical framework for modeling decisions where outcomes are partly random and partly under the agent's control. The MDP has 4 key parts. 1. State the system tracks 4 critical factors: time remaining, the ratio of remaining inventory, how much stock you still need to sell, the logarithm of the asset's price, and the logarithm of its volatility. These variables give the algorithm a snapshot of the market's current state. 2. Action, the agent decides how much to trade at each step. The action is a fraction of the remaining inventory, scaled between 0 and 1. For example, if you have 100 shares left and the action is 0.5, you'd sell 50 shares. 3. Dynamics, this is where the magic happens. The environment simulates how the asset price and volatility evolve over time. The Heston model governs the price, while a special scheme called the CIR, Milstein method, handles the volatility. Importantly, trading itself has real-world consequences. Temporary impact, like a price drop from selling too fast, and permanent impact, long-term effects on the market. These are modeled with equations that include nonlinear and linear terms, reflecting how markets react to trading activity. 4. Reward, the algorithm's goal is to minimize costs while managing risk. The reward function penalizes both the direct costs of trading, like price slippage, and the risk of holding inventory. There's also a terminal penalty, if the agent doesn't fully liquidate its position by the end of the time horizon. The environment also has some unique features. For instance, time is split into 100 discrete steps, and the model incorporates nonlinear temporary impact, a more realistic representation of how large trades affect prices. Plus, the agent is forced to fully liquidate its inventory by the end, mimicking real-world constraints. What makes this research stand out? It bridges classical finance theory with modern machine learning. By simulating complex market dynamics, researchers can test how well different strategies perform under uncertainty. And with reinforcement learning, the agent isn't just following rules. It's learning optimal behaviors through trial and error, much like a human trader would. So next time you hear about algorithmic trading, remember, it's not just about speed. It's about smart, adaptive systems that learn to navigate the chaos of financial markets. Thanks for watching. Hit that subscribe button for more deep dives into the future of AI and finance.